Hello, my name is Brian Sikorsky. I'm an independent financial planner and wealth advisor with Stratos Wealth Partners. I'm located outside of Raleigh, North Carolina. I was raised in a small suburb outside of Detroit, Michigan. My dad worked at Ford Motor Company. I eventually worked at General Motors for a number of years. And life was pretty good as we knew it until my dad passed away when I was a teenager, leaving me, my brother, two sisters, and my mom to fend for ourselves. So as a financial advisor, I am passionate about ensuring that my clients do not repeat the mistakes that my family made, so that hopefully if an unexpected event occurs, they're not left out in the cold like we were for a number of years. Today, our topic is Outlook 2023, the path towards stability. This is for the mid-year, and this follows on after 6 months of the last presentation for the Outlook for 2023. So if we look at the economy, we can see that we're a bit of a pendulum in a stable, overall stable financial system. And we see things like in the US, we've got inflation easing despite a low unemployment rate. So we're doing better with an unemployment rate in this past December, 3.7%, significantly better than Europe and emerging markets at 6%. So we expect inflation to ease as supply chain conditions have improved. Labor markets have been strong as companies have struggled to find qualified workers. Now, even amid a strong labor market, small businesses plan to slow expansion plans as the Federal Reserve, or Fed, maintains steadfast on price pressures. This could in turn cause the economy to soften further. As more multi-family units are available, this should help alleviate some of the housing price pressures, aiding the inflation landscape. And post-pandemic purchasing dynamics could soon move to pre-pandemic levels, where services, not goods, may be the major focus for consumers. If we look at equities, we can see that stocks no longer appear attractive relative to bonds. And we see supportive stock market indicators like these are instances where we're looking back at repeats of history to see if we can match them to today. So if we look at years following a down year in the past, we've had an average gain of almost 15% or over 15%, 84% of the time. So a lot of these are very positive forecasts at the moment for stocks. Now, when looking at the equity risk premium from a valuation perspective, which is comparing earnings yield for equities, so earnings divided by price, to the yield on bonds, we use a 10-year treasury. Bonds at the moment appear more attractive than equities. And that's not the case 6 months ago. People were pushing very aggressively out of fixed income, out of bonds, because they all but guaranteed a loss. And we expect earnings to be around 213 for the S&P 500 index this year. And second quarter earnings reports are going to be announced shortly. And this estimate could be subject to change amid disinflationary conditions. Nevertheless, I did read recently that today's interest rates are essentially the highest that they've been in almost 22 years. Given all the focus on earnings declines do not necessarily correlate with lower stock prices. And this is another reason why it's important for equity investors to focus on the long-term perspective. Bear market conclusions have proven historically positive for equity investors the vast majority of time. So we're looking at when the end of a bear market has occurred, what has been the rate of return for the S&P 500 in the ensuing 3, 6, and 12 months, almost 19%. So once the Fed, if we look back at that past market history, and once the Fed is done raising interest rates, Treasury yields have declined and bond prices have increased. And this is a positive scenario for fixed income investors. And not only that, but also trending a little bit more towards returning to some aspect of normal, as what we would call normalcy. And our base case is that the Fed is near the end of tightening rates. Now look at past market history. Once the Fed is done raising interest rates, core bonds have performed well. And this is, again, another positive scenario for fixed income investors. Fixed income valuations are presently attractive in comparison with history. We believe this scenario positions fixed income investors very well for future returns. Given the hawkish Fed mandate, short-term bond yields are quite attractive compared to the past 10 years. Now, the present banking landscape is something in which we are focused very closely. Lending conditions continue to tighten for both high-yield companies and commercial and industrial loans in the bank space, which could be a negative for companies that rely on high-yield debt to fund their operations. High-yield debt meaning bonds with less than perfect credit quality. From a technical analysis perspective, we believe that the present 10-year Treasury could be at its highest point, and this is a positive scenario, again, for fixed income investors. So turning to commodities and currencies, the US dollar has witnessed much turnover as central banks have shifted to gold holdings. The present geopolitical climate has contributed to this as China has witnessed Russia sanctions amid the Russian-Ukraine conflict, and as China has focused on its military prowess. Now, gold has performed very well compared to other industrial metals, and part of the reason is due to non-US central banks' focus on gold amid inflation and the global political climate. Now, hedge fund categories produce positive alpha in most of the volatility regimes. So this may be a reason for appropriate investors to possibly consider alternative investments. And if you're a client of mine, you've heard me talk about this for the past 6 to 9 months. Amid market volatility, the hedge fund category tends to produce alpha when equity market conditions are volatile. And alpha is the return on an investment that's incrementally more than a benchmark, such as the S&P 500 or other appropriate benchmark. Now, this is a reason for appropriate investors to possibly consider alternative investments. Amid market volatility, global macro strategies tend to produce alpha when equity market conditions are volatile. Presently, we are positive on developed international equities given Japan's historic and corporate climate. Large companies tend to do well during economic slowdowns. Preferred securities along with mortgage-backed security valuations presently look attractive. Given central bank actions and the geopolitical landscape, precious materials look attractive as well. Given the economic climate, we're concerned with small and mid-sized companies and believe that present consumer discretionary valuations are high compared to their fundamentals. In addition to commercial real estate fundamentals, they remain a concern, especially given the present credit landscape. So with that, I'll say thank you very much for joining me. I've put up my website here, BryantSikorsky.com. And if you want to essentially review the materials that led to this report, you can see here I've got LPL Research's Midyear Outlook 2023, and you can click on this and download this report if you like a hard copy. Or if you want to watch this video again, you can go over here to my YouTube channel and click on that, and you can see all the different videos that I've saved. So again, thank you very much for joining me. Hope you have a great rest of your day.